Hello everyone, welcome to Quantsapp. Welcome back to yet another video. In today's video, we will understand about the option trading strategies that we can use in sideways market conditions. So the best part about options is that the theta will kill the premium, the time will decay the premium, right? And if the market remains sideways, so one of the simplest strategies that we can do is we can simply go ahead and sell call and put option and benefit from the theta decay, what is happening in the market. But is it that simple? Can we go ahead and randomly sell calls and puts and can we make money? And the answer to that is no. But obviously, if we learn some option trading strategies that we can use in the sideways market condition, then this entire process gets much more interesting and it gets much more effective. So first of all, before we move towards strategies, let's understand what we are trying to do. Now, if you see, let me just select 9th November expiry. So I'm in the option chain analytic in Quantsapp. You can all access to the option chain tool from the link in the description box below. The link would be also there in the iCard over here. So option chain tool is free for all the users who have signed up with Quantsapp. So I would recommend you to access the option chain from the link in the description box below. So now to start off with, now if you see theta, so for 9th November expiry, 19,400 strike price call option, the theta is 14.5. It is trying to tell us that if everything in the market remains the same, only one day moves ahead. Okay, if we move ahead just by one day, this premium which is quoting at 67 rupees, it would be decayed by 14 rupees just because of time decay. Okay. Now, if the market remains sideways, we know that this time decay is something what will happen, right? And it will give me money if I sell this option. Let's say I sell the option at 67, and if nothing happens tomorrow, I still get 14 rupees of theta decay from this particular option. And same is for the put side as well. So now what I'm trying to capitalize is that I have one forecast that the market will not move a lot. The market will remain sideways. But my premiums will melt because of the theta which is decaying in the market. So more or less, this is what we will get to see, that the call and put option are both melting down slowly and steadily. That is happening because of the theta decay, what is happening in the market. So one strategy that comes to our mind is let's sell 19,400 call and 19,400 put, right? So that is called as a short straddle. But trust me, that strategy comes with an unknown loss. We might lose a big chunk over there, one big movement, and our entire PNL would get wiped out. The slow and steady, consistent returns that we make from the market, those will get wiped out in one single trade. So let me just show you. Okay. So let me just open Quantsapp on another tab. Okay, let me just use the search panel and navigate to the architect tool in the application. Options architect. So options architect is a strategy builder wherein it will help you in analyzing your option trading strategies like never before. Only thing we need to do is just create a strategy and analyze that. So let's say I have sold this. Okay. And one more leg I wish to add, which is put option of 19,400 and sell it. Okay. So again, why I'm doing this? Because I'm expecting the market to remain sideways and I'm going ahead and selling a call option and I'm going ahead and selling a put option. Now this is how the payoff look like. So even the options OI is plotted on the graph, but if I wish to hide it, I can simply click on the OI panel over here and I can hide it. Now, if you see, it's trying to tell you that if market remains within this zone, the break-even points are also mentioned, the expiry break-even 1, expiry break-even 2, that if the market remains between 19,282 and 19,518, then this strategy will give me money. Okay, that is where I will make profit. But the problem of this strategy is that if there is a big movement that happens in the market, okay, let's say if market goes to 20,000 till expiry, right? It may go, right? So if that happens, I will lose 33,000 over here, right? So just to earn 5,000, how much risk I'm taking? I'm taking a risk of 33,000 and vice versa on the downside. Let's say if market goes at 18,780, I'm losing 25,000 over here. So the problem with this type of strategy is short straddles, short strangles, wherever naked selling is involved. The problem is one big movement and small, steady, consistent PNLs that we make, they get wiped out in a single trade. So in order to save ourselves from these kinds of moves, what we need to do is we need to hedge. Okay. So how can we hedge? So it's very easy. What I'll do is I'll buy a far OTM strike price put option so that my downside gets hedged. And also I will buy a OTM call option, so that if the market moves upwards, still I am protected. I will lose money, that's for sure, but I will not lose a big chunk. So let's try doing it. So what I'm doing is I am actually buying 19600 strike price call option 8.3. Okay, the premium is, and I'm also buying 19,200 strike price put option. The premium is roughly same 8.8. So let's try adding it. So 19,600 and call. Add like 19,200 and put. Okay. So this is how the strategy looks like. Now, if you see, you are not losing a big chunk, right? You are not making any undefined losses. So you'll make loss, but that loss is capped at all given points. And eventually, if we keep on adjusting, or if we just modify these legs, the bot legs here and there, then obviously the reward to risk will get more amplified. But the idea is that if I want to create a strategy in a sideways market condition, this would be one of the good strategies, which is short iron butterfly. Obviously, the bot legs I can adjust, I can bring them closer in order to maintain the reward to risk. So let's try to do it. Let's say if I do this of 100 points away, okay, and this too if I do it 100 points away, okay. Now if you see the loss that you are making, it is relatively less, right? It is just 1400, but profit also, the first of all, the range which you were getting earlier, it has shrunk, and also if you see the profit that you are making, it has also reduced. So depending on how much premium the market has to offer you, accordingly this strategy will adjust itself. Only thing we need to do is we just need to modify the strike selection a bit here and there. So this is first strategy, which is short iron butterfly. Now the same thing can be done using strangles. So what we can do is we can actually sell 19,300, and we can also go ahead and sell, let's say 19,500. Okay, we can sell those, and we can buy further OTMs, and that will become like my condor. So now the difference between a condor and the ironfly will be you'll see that a peak is appearing over here, right? Over there, you will see more like a flat curve getting formed on the top. So these are, few of the strategies that we can use. Another thing is, if you just observe theta, 19,400 theta, it's 14.55, right? Now, if you see 16th November expiry, same 19,400 strike price theta, it's 6. If you go further far away at 23rd November, then you see the theta is 4. Now, what we learn from here is, closer to the expiry we are, faster the theta decay, far away from the expiry we are, slower the theta decay. So now we can, create a benefit out of this by selling the current expiry and buying the next expiry. Okay, so basically I will go ahead and sell 19,400 of this expiry, and I will buy 19,400 of next expiry. So what will that create? That will create me a calendar spread. So let me just recreate the strategies. So let's say delete legs. Okay. So let's say short call. Now why I'm doing this? Because I know that the theta will decay from the current expiry much more faster. That is the reason I'm selling the current expiry 19,450 strike price call. Okay, and the next expiry I am buying it. Now it has, this is called as a calendar spread, wherein the best part of the strategy is you will not make any undefined losses. Also, you will gain some benefit from the theta decay as well. If you see your net positive on theta by 400, obviously it will not be able to give you a theta high as a short straddle or a strangle, neither as an ironfly, but this is also a good strategy wherein you are making decent returns with a capped loss. You are not making undefined losses over here. One more thing, what we can do is in sideways market conditions, wherever we expect the market to drift, in that direction, we can create the calendar spread, or in that direction, we can create the ironfly or the iron condor. That means if I'm expecting a slight bullishness to happen in the market, I will create the calendar spread, let's say at 19,600. So this peak that you're seeing now, which is at 19,420, that will happen around 19,600. So wherever you create a calendar spread, that is the point where you will make the most profit. So yes, folks, that was it from my side for this video. I hope you liked this video, and do check out the link in the description box below, and do check out the tools such as option chain and architect, and analyze your strategies like a pro, plus trade all the market conditions with proper option trading strategies. Happy trading.